everybody. Luke Gromen, FFTT. Hope you are well and had a great weekend. Going to jump right into the update today. First question from Punish. Other than gold and Bitcoin, which assets are good to own given current macroeconomic conditions? Is real estate still a good asset in this environment? We've been talking a lot where balance and low leverage is the key in this environment. Things are happening that haven't happened in at least 100 years, if ever. And things are highly political, highly geopolitical, and so it's really important to remain balanced and to remain under-levered. We've been talking about we came into the year with 25-30% in cash and short-term treasuries, 30 to 35% in gold and Bitcoin, and then a blend of energy-related commodities, industrial equities, etc., is how we personally have been allocated. I personally have been allocated, and that's been our recommendation, continues to be our recommendation. In terms of real estate, without getting into too much detail, I think it depends on the asset. If it's cash flowing, luxury, unique, finite, then I think absolutely it's a good asset. Farmland, timberland, lake houses you can rent, beach houses, things like that, I think are and remain very attractive pieces of property. I think there's other areas where there's probably still some risk in terms of possible reductions in lending, in terms of potential refinancing risk, things, certain strip center and retail, given changes in the economy, etc., in terms of certain office, commercial real estate places, and centers. Those are the types of things, I think you take on a case-by-case basis in terms of there being risk. As they always say, all real estate's local, right? I think that may be never more true than right now. From FH, how problematic is the recent clampdown on crypto in the U.S. for Bitcoin? It's likely going to increase volatility even more, and that's something you have to be prepared for. I don't think it changes the ultimate outlook. I would manage it and have continued to manage Bitcoin volatility, not by trying to trade around it, but by simply managing position size. If you are up, checking your price of Bitcoin and you're getting all excited when it's up and it's not when it's, and getting all upset when it's down, you're too big. Get smaller. And so I think it's really important to understand it's probably going to increase volatility even more. Manage it via position sizing. The other thing is I would encourage you to keep coins off the exchanges. You can use exchanges to buy, but I keep my coins off exchange on a cold storage app that was recommended to me by people that I really trust on Bitcoin. From SS, detail about how difficult it is for the world to transition into a new world reserve currency other than the dollar and maintain it. Some think it's going to happen by September. To me, the biggest misperception I see regarding this whole dollar reserve currency discussion is the argument that something else, some other fiat currency will replace the dollar. I keep hearing what will replace the dollar, what currency is going to replace the dollar's global reserve currency. That argument is a total straw man argument. Nothing's going to replace the dollar as global reserve currency. Other fiats don't want it. The Chinese do not want the post-$71 system. Europeans, while they had a chance to have it, I don't think they do anymore, did not want it with the euro. The new system that we are transitioning to, despite gnashing of teeth, screaming, yelling, arguing against it, is already 10 plus years underway. And that shift, that new system is price commodities, and in particular energy, in multiple currencies, settle trade imbalances in local goods, and then net settle in physical gold and maybe a little bit of local sovereign government debt. A little bit, maybe. The World Bank and the IMF talked about this in 2010 and 2011, respectively. The PBOC talked about this in 2009. The Eurozone was talking about this in 1999. And so if people are saying it's going to take decades, it's been decades. The Eurozone was really preparing for this in the 70s. We're 50 years in. And so there's two straw man arguments out there that I just sort of shake my head at, which is what fiat's going to replace the dollar? None. And nobody's trying. And number two, that's going to take decades, so we have decades. We're decades in. So over time, this new system will facilitate or drive currencies to trade on relative balance of payments. In other words, the bigger the deficit, the weaker your currency against gold, and the stronger the bigger your surplus, the stronger your currency is against gold. As the currencies reorder, what that looks like is the dollar is the dirtiest dirty shirt, the sterling is the second dirtiest dirty shirt, and the yuan and the yen rise significantly against both as you reorder to a more balance of payment-centric global system. That's going to allow rebalancing that everybody needs anyway. We keep hearing, well, the Chinese need to consume more. Well, they'll consume more of their own production if their currency strengthens because commodities will be cheaper to them. We keep hearing, well, the U.S. needs to reshore. And to be clear, I'm one of those voices. That can't happen unless we produce more of our own consumption. We need a weaker dollar to do that. This will facilitate that. So this is a win-win-win for sort of everybody. It gets the system to where it needs to be. The only loser in all of this is debt on a real basis. And with how much debt we have, debt is going to lose on either a real basis or on a nominal basis. But after 40 years of debt winning, debt's got to take its turn in the spanking machine. From Hume, how can the U.S. prevent de-dollarization? How much a percentage of global trade conducted outside the dollar is intolerable to U.S. interests? That's the paradox. This isn't Iraq. This isn't Iran. This isn't Libya. This is China and Russia. World's biggest energy importer, world's biggest energy exporter. Factory of the world, biggest country by landmass. War or sanctions against China or Russia will only massively accelerate de-dollarization because inflation will skyrocket globally in war or sanctions against either. And that forces more treasury selling to raise dollars by the rest of the world. It also would necessitate non-dollar settlement on all trade immediately because if you think war or sanctions against China are going to lead China to still accept dollars for all that production they do for our economy, that strikes me as incredibly naive. It's not what happened in World War II. So paradoxically, trying to run the sanctions or war playbook against these two because they're so big and interconnected will only accelerate the process of de-dollarization of commodities. The alternative is that the U.S. takes the lead and implements industrial policy, reshores production to restore our economic production vitality and capabilities, particularly as it relates to the defense industrial base, and that will also promote de-dollarization around the world. And I think that's, again, we're in the fog of war right now. We're between two trapezes, whatever metaphor you'd like, but I think that's where this movie is going. From Carmen, what do you make of the recent segments on both CNN and Fox regarding world reserve currency status about the dollar? Is this mainstream news recognition a signpost for you? I think it's very curious. I do think it's a potential signpost. I don't think they got all of the angles right, or at least as the way I see them as correct, the way the change we've been hypothesizing / observing. But the fact they're talking about it, I think, might be very important because when we start getting multiple U.S. mainstream media channels all pushing a story, oftentimes there's a reason for it. So, well, let's see. It's still early. From Jordan, do you think peak cheap oil is more deflationary than inflationary, given that it will destroy paper assets and derivatives over time? Do you think central bank digital currency is a tool to control inflation by controlling spending? As we are approaching the energy cliff, how much demand needs to be destroyed? Peak cheap energy, if not offset with a revolutionary energy productivity breakthrough, is inflationary in some areas, deflationary in others, and then I think it depends on the reaction of authorities. Historically, if you look, anytime energy spend as a percent of GDP gets over sort of mid-single digits in the developed world, it's driven a recession, and that's initially deflationary, to your point. As peak cheap energy is understood to be a secular trend, or as authorities print money to avoid sovereign debt default caused by peak cheap energy, That's going to drive a secular inflation because investors are going to go, wait a second, peak cheap energy is real. I can't own fixed rate debt. I have to get into things that preserve my energy purchasing power. And the debt markets are way bigger than any other market. So you're going to get debt flows into commodities, into gold, into Bitcoin, into equities, anything that preserves purchasing power. And as that happens, that's pretty inflationary. As increased money supplies, as peak cheap energy forces authorities to print to more fully reserve sovereign debt, right? You go into recession with debt levels this high, sovereign debt levels, particularly in the West, this high, authorities have two choices. They can default on their sovereign debt or they can print money to stave that off. They almost always do the latter, and that's inflationary over time. CBDC, I think it could be used to control inflation because it can be used to control people. That's not a happy outcome, right? That starts to look like USSR, centralized control of the economy. I'm not a fan of that. In theory, a lot of demand would need to be destroyed in an energy cliff situation, but again, there's massive levels of debt outstanding that are all based on no energy cliff, an assumption of no energy cliff. So an energy cliff with massive levels of debt that were taken out, assuming no energy cliff, means you either get a huge wall of defaults, which initially, again, is deflationary until sovereigns start defaulting, which won't take long. Because when sovereigns default, remember, the sovereign debt essentially backs these fiat currencies. So if you have the backing of the currency defaulting, shrinking, that's the denominator of a fraction shrinking, which means the numerator goes toward infinity. That's highly inflationary. What that looks like is, as sovereign debt is, if authorities don't print the money to keep it nominally solvent, sovereign debt goes from being risk-free to being risky. That's a world no one's ever seen before. What do you do in that world? You get out of sovereign debt, and first thing you go into is gold, physical only. You go into a Bitcoin, you go into commodities, you go into real estate, you go into equity, anything that reduces your counterparty risk and preserves your purchasing power relative to that inflation. So that's why I think ultimately an energy cliff, while initially deflationary, it isn't going to last long. It's going to be real hard to trade. I prefer to hedge that by simply managing my liquidity, not having a lot of leverage, and playing for the end game, which is very inflationary. I also think it's why holding overweight reserve assets in physical form, so to speak, that have no counterparty risk is key for this part of the cycle. That's physical gold, Bitcoin held off the exchanges, maybe even some physical silver as well, although there's an industrial component there, since central banks don't own silver. And then finally, RM. If you are an RIA managing a $1 million portfolio for a retiree who needs to make a 3% real return for the next 20 years, how would you allocate now? I'd probably go 1% Bitcoin held off exchange. I'd go 20% physical gold. I'd go 10% treasury tips. And then I'd probably do 60% in a variety of different diversified balanced equity funds that are paying healthy dividends and that have some pricing power as sort of their mandate. Their companies that they own have some pricing power and that have low leverage. They have good balance sheets. And then I would probably put the last 10% into some sort of commodity-based real estate fund that invests in farmland or invests in timberland. I have a good friend of mine who runs a institutional fund that invests in blueberry farms, for example. It's a good business. And those are true inflation hedges. There's no fudging the inflation. It's based on yields. It's based on crop prices. Lumber is very sort of steady and permanent if you manage that. So that's how I'd answer that question. So that's going to finish up for today. If you like these updates, check out Tree Rings, FFTT-treerings.com. This week we have a promo going on. If you're interested in it, 10 most interesting things and what grabbed our attention about them and whether they either supported or refuted a way we had previously been thinking about the world. A lot of great feedback on it. Like I said, I have a promo running this week. So with that, I'm going to sign off for today. As always, thank you for joining me and look forward to chatting with you soon. Everybody have a great week. Take care.